Hello, I'm Julie Price and welcome to Juniper's second quarter 2020 economic review. So I started off last quarter's review with a hearty congratulations to the United States of America for its first decade without a recession. And here we are, two black swans, two totally unpredictable events, a global pandemic and the collapse of oil. And I'm going to walk you through both of those. And then we're going to talk about the Fed's monetary response, the government's fiscal response, and the spread and the eventual containment of the virus itself. So this quarter's review is going to be a little bit more lengthy, but I think you'll really find it worthwhile. So make sure you stick through it all the way to the end where I give you my thoughts on recovery. And no crying. Here's the matrix through April 22nd. Usually I run them through quarter end, but as you know, the story continues. Fixed income is up 4.8%, the only positive asset class, along with, of course, cash. It's been a place of safety as stocks have fallen. The asset allocation is a blend of 60% equity, 40% fixed income, and so that was down 11.8%. So just a reminder, that's a diversified portfolio, which we use to balance the risk-return trade-off. High yield down negative 12.2, and of course that's the more riskier ends of bonds. Then we have large cap U.S. equity and real estate, as well as international, which is emerging markets and developed markets equities. And then at the bottom was commodities and small cap U.S. equity. So not a great start to this year. So JP Morgan has officially added this recession to its historical record going back to 1928. They've called it the global slowdown due to COVID-19 and the oil price war. The market's peak was February 2020, and so far the bear market return has been 17%. The duration so far, two months. So this is a recession, although it's not the typical definition of recession with 2 negative quarters of GDP growth, but we know we're headed there. But if you look at the history here of the macroeconomic environment, that it's not, they haven't identified any of the usual causes like commodity spike, aggressive Fed, or extreme valuation. It was truly a two black swan event. So the bull market began in 2009. A bull market returned 401% with a duration of 133 months. Here we have the last 3 business cycles and the run-up of the last cycle and the decline of 34%, and it's already recovered half of that, thank goodness. And so what do we do in times like this? Well, we go back to our original plans, our feelings toward financial risk and return. And so if you had a moderate view toward financial risk and you had a 60% equity, 40% fixed income asset allocation, because of the drop in the stock prices, you probably had more like a 55% equity, 45% fixed income asset allocation. So this was the end of the quarter. All of the big retirement funds are rebalancing, like the Target Date 2030 funds. So I just went ahead and started rebalancing accounts about this time, and I hope in the long run that will show to have been a good time to rebalance. We've been following the price-earnings ratio of the S&P 500, and right at the peak in February, the PE ratio was at 19, and at the bottom, it was 14 times earnings, and here it is April 22nd, and it's already back to 19. But prices have only recovered halfway, so why is the PE ratio all the way back to pre-crash levels? The E in the equation, earnings, we're looking looking at forward earnings, the next 12 months of earnings, and those have been dramatically revised downward at a rate of about 16% year over year. And the stock prices are down 17%. If the P and the E are both down at the same rate, I understand the math, but what does it mean? The 25-year average is 16.33 times earnings, so are stocks overvalued in the middle of a recession? We're having a difficult time explaining this, but we know that investors have to essentially ignore the next 12 months of earnings. The first key response to the stock market crash was the Fed's monetary policy. The first thing they did is they took rates to zero, and that did little to quell fears. They started making unlimited asset purchases, and so when the government makes large purchases of securities, what that does is it holds up the price in the market. The goal is to create liquidity and to free up credit. And so what they did is they reduced the reserve requirements for the banks, and so that allowed them to make more loans. And then they started buying mortgages and filling up their balance sheets with a diversity of different types of securities, even going into the high yield ETF world. And so that's something that they've never done before. So you can take a moment and pause and look at some of these other actions that they did, but it was basically bazooka after bazooka after bazooka. With the Fed taking rates down to zero, that's changed the yield curve dramatically downward here in this blue line. Just most recently it was inverted, and we were comparing it to a normal sloping yield curve back from 2013. So you can see why the outlook for bonds is deteriorating. Here we see the developed market central bank bond purchases going back to 2016 and also forward looking in the next year or so. So what we see are the four major developed banks: the Fed, the U.S. Central Bank, the Bank of Japan, the European Central Bank, and the Bank of England. And so of course the United States has got the biggest contribution here going forward, and the European Central Bank is not far behind. Right now the Fed is contributing $41 billion they're buying a day in assets, so quite a bit of an infusion, not just here but all around the globe. And looking at the chart on the right, we see the number of rate changes by emerging markets and developed market central banks. In 2019 we saw a great amount of cuts, and quite a bit in 2020, being that we're just into April. So quite a bit of action in the global central banks. The second key response to the stock market crash was the government's fiscal relief packages, and most notably the CARES Act. So what this act did was infuse $290 billion in stimulus checks, $60 billion in enhanced unemployment benefits. And what this did was add $600 per week to each benefit check, and then $510 billion to loans to distressed businesses. And then there was the payroll protection program and other forgivable loans, health-related spending. All in all, $2.3 trillion in stimulus. Now that's 11% of GDP. And so if you want to look at it in a different light, the annual budget of the U.S. government is $4.6 trillion. So this was half of our budget in just one act. And this was a tremendous infusion to the economy, and no doubt helped support markets. Looking at federal debt, we are at 79% of GDP. The Congressional Budget Office forecast that we would eventually be at 97.8% of GDP in 10 years. JP Morgan has already revised that upward to almost 111%. And so the CBO will be adjusting their data eventually as well, but a pretty amazing stimulus by the government into the economy. I'm going to spend some time talking about oil, the other black swan. The pandemic is so front and center in our lives right now. Oil has been overshadowed by it. Let me start by giving you a little background on OPEC, the Organization of the Petroleum Exporting Countries. Member nations agree on how much oil to produce so that everyone profits. The goal is to prevent other countries from trying to cheat by producing more to get a bigger slice of the pie. Russia is not a member of OPEC but attends meetings. So looking at oil demand, transportation makes up 65%. Because of decreased demand due to the pandemic, OPEC member nations agreed to decrease production. Now, OPEC is led by Saudi Arabia, and they asked Russia to decrease production as well, but they didn't. So then this massive glut of oil amassed, sending prices plummeting. And you can just see the start of a massive reduction of U.S. oil rigs and a massive increase of oil inventory. Every oil container around the planet is going to be filled with oil. They're even storing it in pipelines. Before the pandemic struck, oil was trading at about $60 a barrel, fell to $11 at the lowest, and it's up to $16.50 now. In order for oil to be profitable enough for oil companies to drill, it has to be at least $45 a barrel. Shale oil costs $10 more to extract because you have to break through that hard layer of rock. So U.S. production of oil is going to pretty much be at a standstill. Profits in this sector is going to really be mainly based on the global macro environment. It is a long-term speculative investment. With oil prices so low, companies are having to decide now between slashing dividends or cutting production. And that's not an easy decision to make because oil wells are expensive to maintain and reopen. So what kind of companies might be able to survive the shock? As long-term investments, you might want to look at integrated oil companies. Those are global firms that participate in the exploration, production, refinement, and distribution of oil and its byproducts. By diversifying revenue streams, you diversify the risk and not concentrate it into one segment like domestic oil. Examples of integrated oil companies are Exxon, BP, Total SA, Royal Dutch Shell. These are all companies that have a medium risk rating by Morningstar. A very different environment indeed. Now that we've covered the fiscal and monetary responses, let's look at the third key area, the spread and containment of the virus itself. Before markets can return to normal, we need to have the virus contained so that we can go out and enjoy the things that we love. But we need to attain herd immunity somehow through massive infection or a vaccine or even an effective treatment. But realistically, we're looking at 18 months. The key number to look at to determine if the virus is under control can be found in the transmission rate. At a rate of 2, it means that each person gives it to 2 people and they transmit it to 2 people and so on. By the 6th round of transmission, over 4 billion people are affected. So you can see why we really needed to flatten the curve. But when the transmission rate is below 1, exponential functions are our friend. For example, with the transmission rate of 0.8, that means that each person gives it to 0.8 people, meaning out of 5 infected person, 4 pass it on to 1 person, but the 5th person infects no one. And the number gets exponentially smaller, all other things equal. And that's a big if, especially with varying levels of compliance to social distancing. Homes with infected occupants, regions with high population density, they're going to generally have higher transmission rates. But at a level less than 1, the disease is manageable, but we need to be at least 60% herd immunity. Until then, we need to focus on a safe reopening plan that balances the health needs with our economic needs, and there is no easy answer. I was curious how people were adhering to various degrees of lockdown, and then they came across Google mobility data. It tracks the movement of people by looking at their receipts and GPS data. So the way you read this chart is that 0 is a normal baseline. So when it's above 0, that means they're doing this activity more. Below 0, they're doing it less. So I compared Michigan, who has a stricter policy, to Georgia with a more lax policy, and where we're at in Washington State. Then I added Sweden, who has chosen to go with the goal of herd immunity and has no lockdown measures in place. As you would expect, in most cases, people are adhering to stricter guidelines, like in Michigan, the blue line, and Washington in green. And even when there is no lockdown measures in place, like in Sweden, you still see the same social distancing trend. Not the same degree as stricter countries, but under their normal 0 baseline for transit, retail, workplaces, groceries and pharmacies. They're spending more time at home, and frankly, I'm a little jealous that they and others are able to enjoy the parks more than Washingtonians. But this data indicates that the fear of contracting the disease may be almost as much of an incentive to social distance yourself as regulations. So don't get me wrong, social distancing is powerful. I was just surprised to see the data. Sometimes data doesn't fit your thesis, and an honest analyst will show you that. However the virus is contained, economic recovery will hopefully soon follow. Here are 5 of the hardest hit industries due to the pandemic. They have sales models that are predicated on servicing large crowds. The biggest, of course, is retail, excluding food and beverage, and restaurant and bars. But it also includes entertainment, hotel and tourism, and transportation. We spend 1/5 of our GDP on these industries. When it comes to employment, there are just as many employees at restaurant and bars as retail, even though we don't spend as much on those industries. And then when it comes to investors, we're looking at earnings, and these industries represent 7% of operating earnings of the S&P 500, and retail is the biggest segment in there. So no doubt that we will see decreased earnings and earnings at all. M&A activity, merger and acquisitions, and sadly, we're going to see a lot of bankruptcies. As you know, we're seeing unprecedented unemployment figures right now. The next numbers will be out on May 1st, but we have 4.4% in this chart, but realistically, here in April is probably more like 13, 14, 15%, which you can see in the history here that it's not been at that level for quite some time, probably going back to the Great Depression. High-yield bonds have lower credit quality and higher coupon rates to compensate investors for the additional risk. Currently, the default rate is at 3.35% and has slowly been increasing from a default rate at about 2% last year. It's getting closer now to the 30-year average of 3.5, and it's probably going to get worse. Oil is in this space, as well as other vulnerable industries. The payroll protection plan does not help firms make their coupon payments, so that's not a bailout for them. Interestingly, high yield is also very correlated with U.S. equities, so we'll see how much that holds true in this environment. But it may be tough to hold high yield for some time. Here's some perspective on how the rest of the world's stocks performed. The MSCI All-Country World Index is shown here next to the U.S., where we both went through a couple of recessions together, and the U.S. took off for 10 years while the rest of the world had some setbacks. Another recession here for Europe. Central bank monetary policy has helped support markets around the world as we try to recover. So far, year-to-date, April 23rd, the U.S. is down 12.9%. Then skim down the list, and the only country that had a less negative year so far is, oh look, China. Japan's not doing too bad either. Europe, excluding UK, is down about 20%. The UK and France are both down about 27%. The strong US dollar is hurting returns almost everywhere. JP Morgan thinks that the environment will change soon enough and help US investor returns. Really tough numbers to look at. The US now represents 58% of the index, up from about 55% a year ago. No doubt the US's strong tech presence, consumer and health sectors contributed. Here we have the same all-country world index, excluding the United States, showing their annual returns going back. And you see so far in 2020 that the local currency was actually down 16.9 and the currency return detracted another 3.5%. So all in all, it was down 20.4%. And so this chart shows you how currency adds or detracts from your international investments. So in 2019, it added, and in 2018, it detracted. So you can see how currency has an impact on returns. We look at the Global Purchasing Managers Index to get an idea of what direction we think international equities are headed. The index represents purchasing manager sentiment for future sales, employment, and inventory that they'll need over the next several months. So it's a leading economic indicator. If their outlook is not good, we can infer that a slowdown may be imminent. Manufacturing PMI is at 47.6 and services are even lower at 37. A sustained level of 42 or lower could indicate that an economy is headed toward recession. Here is the Purchasing Managers Index again in the form of a heat map. And you can see 2020, the forecast is red across all countries. India is still green. I don't think that will probably be green for much longer, but not a good outlook across the board. Well, congratulations for making it all the way through those slides. I just want to thank Dr. David Kelly and his team at JP Morgan for putting together such a great resource. He also put together now daily calls for managers, and it's just been a tremendous benefit for me, and I get to pass some of that information on to you. So at first, Dr. Kelly was saying that this was going to be looking like a V-shaped recovery, and at first we didn't really understand just how deep that this was going to be. The WHO, China, and our own government officials downplayed the severity of it. And as time went on and things evolved, it became more clear that this was going to be with us for a while. But then the thought moved to more of a U-shaped recovery. But this thought is the same when we do get to the other side of this, that the recovery will be vertical. And so with pent-up demand and desire to get back to life as normal. But the experts are actually split 50-50 on whether we've even hit bottom. So if that's the case, we could be in for a W-shaped recovery, and that we could have markets sink lower again. And if that's the case, I've got a little cash to set aside in case we need to invest more down the road. We don't need to put it all in the market right now and today. We have time to be smart about our choices. We certainly wouldn't want to see a L-shaped recovery either. That would be a long, drawn-out recovery. So I'm hoping that we'll see something more in the lines of a U-shaped recovery. But it may be that once the market gets to the point where they feel like there's going to be a turn, there could be a turn in the stock market long before we feel like we're recovered in the economy. So just keep in mind that there are two different things here. There's the economy and the stock market, and they may not move at the same time. So if you've enjoyed this presentation and if you have some thoughts or questions, feel free to give me a call. Also, if you're not a client of mine, I am still taking new clients. I do financial planning and investment management. I have an office in Federal Way, and once things are safe to return there, I can, certainly meet new clients there. I've been meeting some of my clients in their home, but now I've moved to the home office, and I've been doing these video reviews for several quarters now, so this is not anything new to me. I've been online for a while, and now I'm taking meetings by Zoom video calls. So if you like what you hear, you have any questions, feel free to give me a call or shoot me an email. At any rate, be sure to check out my website or Facebook for more content. Thanks, and have a great day.